Welcome to this explainer. Today, we're taking a hard, entirely objective look at one of the single most misunderstood aspects of the financial world. We are breaking down the chaotic mechanics of crypto market swings, and we're doing it using pure facts and data. Look, if you've been watching the charts lately, you know cryptocurrency can be an absolute roller coaster. But today, we're going to transform that chaos into clarity. We're stripping away all the emotion and focusing strictly on the underlying mechanics of what really drives these markets in 2026. To understand why this matters right now, just look at this number, 47%. That is a massive, visceral drop. On October 6, 2025, Bitcoin hit an all-time high of $126,173. But by mid-2026, it had fallen nearly 47%, hovering right around the $64,000 mark. If you were unprepared, a swing like that could easily induce total panic. But as we'll see, these swings aren't a glitch. They are an inherent part of the market's architecture. Okay, let's dive into this. Here is our roadmap for how we'll transform volatility from a terrifying force into a manageable reality. 1. The October 2025 crash. 2. Measuring crypto volatility. 3. Why prices move fast. 4. The 2026 market landscape. And 5. Mastering risk management.
Section 1. The October 2025 crash. A reality check. Because to understand volatility, we have to look at recent, visceral market events rather than just abstract concepts. And this brilliantly illustrates that point. While the 2025 to 2026 crash feels incredibly severe right now, historical data proves that even steeper declines are quite literally a built-in feature of crypto. I mean, look at 2011. A security breach at MGOX triggered a staggering 94% decline. In 2018, the ICO bubble burst, resulting in an 84% drop that took a full year to bottom out. Then you have the 2021 and 2022 crashes with drops up to 76%. What this data shows us is that while the causes constantly change, from early security hacks to today's macro pressures and ETF outflows, these massive pullbacks are consistently followed by extended recovery cycles. For sure, volatility swings both ways. Moving right along to Section 2, Measuring crypto volatility, math, not emotion. We really need to shift the narrative away from the emotional pain of a market crash, because volatility isn't a feeling of panic in your gut, it's a concrete number. In the professional space, it's primarily measured in two ways. First, we have realized volatility. This calculates how much the price actually bounced around over a past window, say 7 or 30 days, using standard deviation. Basically, bigger swings equal higher standard deviation, which equals higher volatility. Then we have implied volatility. This is derived from options markets and reflects what traders expect the future volatility to be. Now, if you're relatively new to this, you should primarily focus on realized volatility. It tells you exactly what the asset has been doing, objectively, without the guesswork. Section 3. Why prices move fast, the mechanics of chaos. Let's look at what actually causes these massive percentage swings. So what's actually under the hood driving this? It's a combo of core factors. First, market sentiment. Fear and greed are huge drivers. Second is speculative trading and social media hype, where folks are just chasing short-term pumps. Third, low liquidity and smaller coins. Fourth, and this is absolutely crucial, crypto is a 24/7 global trading environment. There's no closing bell. You can't just go home for the weekend. And finally, instant reactions to news and regulations. Unlike the stock market, crypto literally never sleeps, so it absorbs global shocks in real time. I really want to zero in on one of those drivers, because it's just so fundamental: liquidity. Simply put, liquidity is the availability of active buyers and sellers in a market. Think of it as the ultimate shock absorber. If a market has strong liquidity, a giant buy or sell order gets absorbed with barely a blip on the price chart. But in a low liquidity market, even a tiny trade can cause an extreme, aggressive price swing because there just aren't enough buyers or sellers on the other side to match the order. Now, what's really interesting about this slide is how we can categorize the market based exactly on liquidity and speculation. On one end, you have high volatility assets, your newly launched meme coins and small altcoins. A meme coin might pump 100% in a single day on pure hype. But because of that low liquidity we just talked about, it can crash just as fast when early buyers cash out. On the flip side, we have relatively low volatility assets like Bitcoin and Ethereum. Now, low is relative here. They are still volatile compared to standard stocks, but thanks to their massive market caps, global liquidity, and heavy institutional adoption, their daily swings are much more controlled. Section 4. The 2026 market landscape, a maturing ecosystem. Let's move to and see how this builds, because institutional money has completely altered the volatility game today.
Back in 2011, during the absolute Wild West days, Bitcoin had an 8,000% rally in a single year. That extreme level of volatility has definitely moderated. Yes, crypto is still about 3 to 4 times more volatile than stock indices, but the relative swings are calming down. A massive turning point was January 2024, when spot Bitcoin ETFs were approved, opening the floodgates for institutions. Add in the structural supply shock of the April 2024 Bitcoin halving, and the stage was set for that October 2025 all-time high of over $126,000. Looking ahead to the next expected halving in April 2028, it's pretty clear this market has grown up.
But hey, institutional money is a double-edged sword. Today, macroeconomic factors like interest rates are deeply tied to crypto. Case in point, during April and May of 2025, over $1.2 billion in ETF outflows hit the market. This wasn't a crypto hack or some scandal. This was just institutional capital moving based on macro conditions, and it created intense real-time price pressure. ETF inflows and outflows are acting as real-time volatility drivers, fundamentally changing the market mechanics in 2026. And finally, Section 5, Mastering Risk Management, your survival toolkit. Because knowing the mechanics is only half the battle.
It is incredibly common for beginners to make emotional mistakes, panic selling during a crash or hype buying into a meme coin pump. So the crucial point is implementing a defensive playbook. Here is your essential survival toolkit. Step 1, position sizing. Never go all in. Seriously, allocate only a strict, defined percentage of your portfolio. Step 2, dollar cost averaging, or DCA. Instead of trying to time the market, invest fixed amounts regularly over time. It mathematically smooths out the volatility. Step 3, use stop-loss orders to automate a sell trigger, limiting your downside during sudden crashes. Step 4, diversification. Spread your risk out so one collapsing token doesn't wipe you out completely. And Step 5, avoid leverage. Borrowing money amplifies gains, sure, but it equally amplifies losses, making you highly susceptible to forced liquidations during rapid swings. When you use all these tools, you fundamentally change your relationship with the market. As this quote sums up perfectly, successful investing in volatile crypto markets requires patience, proper research, strong risk management, and emotional discipline. Understanding volatility isn't about perfectly predicting prices. It's about executing a disciplined strategy over the long haul, letting the math protect you while everyone else is trading on emotion. Which leaves us with a pretty provocative final thought. The market is going to drop again. It is mathematically guaranteed. So when the next inevitable 40% market swing hits, will you panic sell on emotion or will you rely on your risk management math? The choice is entirely up to you, but now you've got the toolkit to make the right one. Thanks for joining me on this explainer. Keep your